Welcome back to the Deep Dive. Today, we're going to be taking a deep dive into the world of synthetic data
Ooh, fun.
and how it can maybe even revolutionize portfolio construction.
I like revolutionizing things.
Yeah, it's always exciting to think about, new technologies and how they can help us kind of, make better decisions as investors and all that.
Especially portfolio construction. That's a very important part of investing.
Yeah, absolutely.
Yeah.
So, I think it's worth starting off by just making sure everyone's on the same page about what exactly synthetic data is.
Yeah.
So think of it like this, imagine you have this crystal ball,
Okay.
right? And it can kind of predict market movements. Obviously, it doesn't exist in the real world, but synthetic data might be the next best thing because it's basically data that's generated by a computer,
Okay.
but it's trained on real financial information.
So it learns from the past.
Exactly. So it's
Yeah.
like it takes all this historical data and it learns the patterns and the relationship.
And then it can make up new stuff.
Yeah. And that's where it gets really interesting because it can create these entirely new scenarios that never actually happened in the real world.
Oh, so it's not just copying the past, it's actually creating something new.
Exactly. And that's why I like to think of it as kind of like a financial simulator.
Okay. Like a video game almost.
Yeah, like a video game for the markets.
Yeah.
So it gives us this playground to test out different investment strategies,
Interesting.
explore different possibilities,
Yeah.
push the boundaries beyond just what we've seen historically.
So we can do things we couldn't do with just the real data.
Exactly. And that's what makes it so powerful.
I like it. So what are we diving into today?
So we have this research paper outlining a new method for generating synthetic data.
Specifically for finance.
Yeah, specifically for financial markets, so things like stock prices.
Cool.
But I think before we jump into the nuts and bolts of their approach, it's important to step back for a second and talk about why this is such a tricky thing to do.
Right, because financial markets are very complex.
Yeah, they're incredibly complex.
Oh.
And even when we have like decades of data, it's still a relatively small sample size in the grand scheme of things.
Yeah, I see that.
And this research paper, they actually use this really interesting analogy.
I love a good analogy.
Yeah, they quote this line from a Mallarmé poem that says, "A throw of the dice will never abolish chance."
Okay, that sounds deep.
Yeah, and basically what they're getting at is that even if we create mountains of synthetic data based on past market behavior, it doesn't erase the inherent randomness of the markets.
Oh, so it's not a perfect crystal ball?
No, definitely not. And I think that's an important thing to keep in mind because it's easy to get carried away with all this, technology and think, oh, we've solved the puzzle.
Right, like we can predict everything now.
Yeah, but that's not the case.
So how much data are we talking about here?
Well, they give this example. They say that even 30 years of daily data, which sounds like a lot to someone like me,
Yeah, it's a long time.
it only translates to about 7,500 data points.
Okay, and why is that not enough?
Because it's not really enough to fully grasp these complex events like major economic shifts or complete business cycles.
Oh, right, because those things happen over much longer periods.
Exactly, and those events can really shake things up in the market.
Yeah, they can completely change the game.
Exactly. And so if we don't have enough data to account for them, our models might not be as accurate as we'd like them to be.
So we need more data, but we don't have it.
Yeah, that's the catch-22, right? We need tons of data for reliable models, but the real-world data just can't keep up.
And that's where the allure of synthetic data comes in.
Exactly.
But I'm guessing it's not as simple as just hitting a button and poof, we have a perfect market simulation.
You're catching on. No, it's definitely not that simple.
It figures.
Because financial data has these unique characteristics.
Or quirks.
Yeah, quirks. They're often called stylized facts that make it notoriously difficult to replicate accurately.
Okay, give me an example.
So think about those black swan events we hear about, those unexpected market crashes that seem to come out of nowhere. Well, these extreme events occur way more frequently in financial markets than a standard bell curve would predict.
Interesting. So the market is more chaotic than we think.
Exactly. And this is called heavy tails. And it's one of those quirks of financial data that makes it so difficult to model.
So if our synthetic data doesn't factor these things in, then it's not going to be very helpful.
Exactly, because it won't give us a realistic picture of the risks that we might face as investors.
Yeah, that makes sense.
And it's not just heavy tails that we have to worry about. There's also this thing called volatility clustering, where periods of high market volatility tend to bunch together.
Oh, like a roller coaster.
Yeah, and then there's the leverage effect where big price drops often lead to even more volatility later on.
Oh, wow. So it's like a chain reaction almost.
Exactly. And all of these factors contribute to making the financial market kind of a challenging beast to replicate.
No kidding. So how do we even begin to create synthetic data that captures all of that?
Well, that is the question, isn't it?
That's why we're here.
And that's exactly what we're going to be exploring in this deep dive.
Can't wait.
Stay tuned. Welcome back to the deep dive.
Hmm. So last time we were talking about, the complexities of generating synthetic data for financial markets, and we dove into this four-step process designed to kind of tackle this challenge.
Right, all those quirks of financial data.
Exactly. But now the big question is like, does it actually work? Can this synthetic data actually help me, as an investor, make better decisions?
That's what we want to know, right?
Yeah.
And to answer that question, the researchers, they put their synthetic data to the test by backtesting a popular investment strategy known as mean reversion.
Okay, I've heard of mean reversion. It's
Blech.
that idea that prices and returns tend to kind of revert back to their average levels over time.
Exactly, like if a stock has been doing really well, it's probably going to come down at some point.
Right. And vice versa.
Yeah, think of it like a pendulum swinging back and forth.
Okay.
Mean reversion traders tried to profit from those swings by buying assets that have dipped below their average and selling the ones that have gone way up. So it's like buy low, sell high.
Yeah, basically.
Okay,
Yeah.
so they use this mean reversion strategy to see if their synthetic data could accurately reflect how this strategy would perform in the real world.
Exactly. It's a good way to test it, right?
Yeah.
So they tested two versions of the strategy. A long-short version,
Okay.
where you buy some assets and you short others. And the goal there is to kind of stay neutral on the market, so you're not betting on the overall market going up or down.
Right.
And then they tested a long-only version where you just buy assets that are expected to revert upwards.
Okay, so they're riding the wave of the rebound.
Exactly.
So they ran these strategies on both the real S&P 500 data and the synthetic data.
Right. See how they compare.
Yeah. What do they find? Did the synthetic data pass the test?
Well, the results were pretty interesting.
Okay.
One of the most surprising things was that the model did a much better job at replicating real-world results for the long-only strategy than for the long-short strategy.
Yeah. Oh, that's interesting. Because I would have thought that the long-short strategy, which is more about exploiting those subtle price differences, would benefit more from having that extra data.
Yeah, it seems counterintuitive, right?
Yeah.
But this actually highlights a key insight from the research.
Okay, what's that?
It suggests that the model might be struggling to capture those more subtle, low-variance relationships between assets.
So it can kind of reproduce the overall market trends, but it's missing those tiny discrepancies in pricing.
Exactly. And those are the things that a long-short trader would be looking to exploit.
Right, okay. So it's it can see the forest but not the trees.
Yeah, that's a good way to put it.
So that's a potential limitation then.
Yeah, definitely something to keep in mind.
Okay, so are there any other kind of red flags or limitations that investors should be aware of?
Yeah, actually, this one's important, especially when you're dealing with limited data.
Okay.
The researchers found that the standard errors associated with their results were huge.
Can you remind me what standard error means again? I know it has something to do with uncertainty, but...
Yeah, so standard error basically tells you how much variability or noise there is around your measurements.
Okay.
Because a large standard error means there's a wider range of possible outcomes.
So even if the model seemed to match the real data pretty well, these large standard errors are saying be careful because the actual results could vary a lot.
Exactly. It's like
Okay.
trying to navigate with a compass that's constantly jittering.
Oh, so you might have a general sense of direction, but you can't be too sure.
Right.
So how does this, how could this impact my portfolio?
Okay, let's say you're evaluating a potential investment strategy using synthetic data, and the model predicts a Sharpe ratio of 1, which is considered pretty good.
Yeah.
But because the limited data, the standard error for that Sharpe ratio could be 0.35.
Wow. That's a huge difference.
Right. It means the true Sharpe ratio could be anywhere from 0.65 to 1.35.
So it makes you wonder how much you can really rely on these models, especially when we're dealing with limited historical data.
Yeah, that's the challenge, right? We need a lot of data to get reliable results.
Okay, so what if we don't have access to that much real-world data?
Well, that's where synthetic data can be really helpful.
Okay, but we have to be careful with it.
Exactly. We need to make sure it's generated using methods that can capture those subtle relationships in the market.
Right, so don't just blindly trust any model.
Exactly. Always be critical.
Okay, so they also did this other test called an identifiability test.
Oh, yeah.
What was that about?
So this was designed to see how well the model could kind of identify itself.
Okay.
So they basically generated a synthetic data set using their model, and then they trained a new model on that synthetic data.
So they're like creating a synthetic data clone of the market.
Yeah, and then they see if a new model can figure out the characteristics of the original model just from that synthetic data.
Okay, so did it pass the test?
The results were encouraging but not perfect, so it means there's still room for improvement.
Hmm, but it's a good sign.
Yeah, definitely.
Okay, so we've seen how this model performs. We've talked about some of its strengths and limitations.
Right.
But I'm still wondering, what does this all mean for me as an investor? How can I actually use this information to make better decisions?
That's a great question, and that's what we're going to be exploring in the final part of our deep dive.
I'm intrigued. Stay tuned. Welcome back to the deep dive.
Hmm.
So we've been spending this deep dive exploring, this really fascinating world of synthetic data and how it could potentially like revolutionize the way we build portfolios.
Yeah, it's powerful stuff.
Definitely. And we've seen how this new model is kind of trying to, crack the code of generating really realistic market data.
Hmm.
But we've also uncovered some, interesting strengths and limitations along the way.
It's always a balance, right?
Right, exactly. So now I think it's time to kind of shift gears and talk about what this all means for investors, like me.
Yeah, how do we actually use this knowledge to make better decisions?
Exactly, because at the end of the day, that's what really matters, right?
Absolutely. So the research actually provides some really valuable insights that can help guide you.
Okay, all ears.
So remember how those long-short strategies kind of tripped up the model a bit?
Yeah, the ones that rely on those like really subtle relationships in the market.
Exactly, the low variance stuff.
Right.
Well, the researchers, they found that the standard errors for these types of strategies were even larger than they initially thought.
Wait, even bigger than those already huge standard errors we talked about.
Yep, especially when they were using smaller data sets to train their models.
Okay. Starting to get a little scared of the word error at this point.
I get it, but it's important to understand why this happens.
Okay, so why does it happen?
It all comes down to the nature of long-short strategies.
Yeah.
They're designed to exploit those tiny discrepancies in pricing that are often masked by the bigger trends in the market.
So it's like trying to hear a whisper in a really loud room.
Exactly. You need a really sensitive instrument to pick up on those subtle signals.
And those signals are easily drowned out by the noise if we don't have enough data.
Exactly.
So the more we rely on assumptions and extrapolations from a limited data set, the more these errors get amplified.
It's like a magnifying glass on our uncertainty.
So what does that mean for investors? Should I be like avoiding these complex strategies altogether if I'm relying on models that are trained on limited data?
Not necessarily, but it does highlight the need for using substantial amounts of data when you're backtesting these types of strategies,
So more data is always better.
basically.
And if we don't have access to that much real-world data, are we just out of luck?
Not at all.
Yeah.
That's where synthetic data can really shine.
Okay, but we have to be careful with it, right?
Right. We need to make sure it's generated using really robust methods that can capture those subtle relationships we've been talking about.
So the key takeaway here is like, don't blindly trust any model, whether it's trained on real or synthetic data.
Exactly. You always have to understand its limitations.
Critically evaluate the results.
And remember that no model can perfectly predict the future.
Right, because the market is always full of surprises.
Always.
Well, I think this has been a really insightful deep dive into this world of synthetic data and, how it can be used in portfolio construction.
Yeah, it's been fun.
Yeah, it definitely has. And I think it's really exciting to see, how this field is evolving and how these models are becoming more and more sophisticated.
Definitely a lot of potential there.
Absolutely.
Right.
So for those of us who aren't data scientists but still want to kind of stay ahead of the curve, what would you recommend?
I think the key is to just remain curious.
Okay.
Keep learning and stay informed about the latest developments in this field.
So basically keep listening to the deep dive.
Exactly.
Huh.
The more we understand about these models, the better equipped we'll be to make good investment decisions.
Awesome. Well, thank you so much for joining us on this deep dive into the world of synthetic data and portfolio construction.
My pleasure.
And to our listeners, thank you for tuning in. We hope you've gained some valuable insights that will help you navigate this complex world of finance and make smarter decisions for your financial future.
And remember, stay curious.
Until next time, happy investing, everyone.